Is your company secretly cannibalizing its own future? While CEOs tout stock buybacks as shareholder-friendly, are they really just inflating stock prices and masking a lack of real growth? Uncover the hidden agenda behind this controversial corporate maneuver. Stock buybacks, also called share repurchases, are when a company uses its available cash to buy back its own shares from the open market. It's like the company is investing in itself. Companies might do this because they think their stock is undervalued, or they want to boost the stock price, or maybe they don't see better opportunities to invest in the company. One argument for buybacks is that they can increase earnings per share. Imagine a pie is being divided among fewer people. Each person gets a bigger slice. Similarly, reducing the number of outstanding shares means each remaining share represents a larger portion of the company's earnings. This could increase the stock price, benefiting investors. Some also argue that buybacks are a more tax-efficient way to return capital to shareholders compared to dividends, especially if dividend tax rates are high. Management might view it as a flexible way to manage the company's capital, especially when they have excess cash and limited investment opportunities. However, stock buybacks aren't always a good thing. Some critics argue that companies use buybacks to artificially inflate stock prices, especially when organic growth is slowing. It's like a quick fix, rather than a sustainable strategy. There's concern that executives might be more focused on boosting the stock price to meet their compensation targets, rather than investing in long-term growth opportunities like research and development or capital expenditures. This can harm the company's innovation and competitive advantage in the long run. Also, if a company borrows money to fund buybacks, it increases its debt and leverage, which can be risky, especially during an economic downturn. Some believe that the money used for buybacks could be better spent on internal investment, innovation, and employee compensation. Looking at the bigger picture, stock buybacks can impact a company's financial health and long-term prospects. If a company consistently prioritizes buybacks over other investments, it might signal a lack of confidence in its future growth potential. This can worry investors and negatively affect the stock price in the long run. It's a complex issue with no easy answers. The impact of buybacks depends on various factors, including the company's financial situation, market conditions, and management's intentions. One thing that remains less explored is how different interest rates impact the appeal and effectiveness of stock buybacks. Or we could examine what specific types of companies are more likely to benefit from buybacks versus which companies are likely to be hurt by them. If you found this video helpful, give it a like, share it with your friends, and subscribe to see more videos like these.